Hey everybody, happy Tuesday to you. We normally send these updates out on Monday, but we wanted to delay this update because the bond market performed so poorly yesterday, and we wanted to kind of give a little context as to why. That way, when you see the charts and you see how much of a drop bonds made or how much of a drop there was in the bonds, to understand, okay, rates increased yesterday and why. And unfortunately, there's no clear reason why, but there is a ton of stuff that basically just hit the market at once. And we've seen stronger than expected jobs data here in the US. China's been stimulating their economy, trying to get it to grow. Some investors are pricing in a smaller rate cut by the Fed than previously thought. And then there's some talk and speculation about who wins the election, whether it's Harris or Trump. There's different ways that they try to project that, and that's putting pressure on bonds. So we see some volatility when we go into elections. So this is kind of par for the course. Yesterday was just kind of a little bit of an exception with this much of a movement. So, we'll see how the bond market recovers over the next couple of days. Now, what we do know coming up, we've got 8 days of craziness starting on October 30th through November 7th. And we had the ADP report, the BLS, the election obviously on the 5th, and then the Fed meeting on November 7th. So we're going to have a lot of stuff that can move the market really, really fast. On top of that, last week we had Fed Governor Christopher Waller out on record saying that basically he thinks the Fed can cut at least another 1.5% in rate by the end of 2025, which means it'll take the benchmark rate from the current level of 4.7 to 5% down to 3.25 or 3.5%. So that's some welcome news. The Empire State Manufacturing Index, which shows the health of manufacturing activity in the New York region. So it's not the whole U.S., but it's an isolated read, but it's also very insightful for what we see throughout the rest of the nation. But it was expected to rise by 3 points in October, but instead it fell by almost 12 points. So this was a much weaker than expected read, and it shows manufacturing continues to be in a recessionary pattern. So something to be mindful there as we go forward. But wanted to give you an update on this, try to point and clarify why we had such a drop in the bond yesterday, why mortgage rates increased like they did on Monday. But hopefully this is a short-term blip. Ultimately, we think we'll return to the upward trend in this bond page to where mortgage rates will start to trend back down. But like we've always said, it's not a straight line. There's ups and downs, there's peaks and valleys, and this is just one of those valleys that we're going through right now. So we should see a return in the bond market, and rates will start to drop back down again. And we'll talk to you next week. Have a great day.